India's biggest FMCG companies, the ones that have been selling you soap, shampoo and biscuits for over 50 years, just spent over rupees 5,000 crore buying small, young brands you've probably scrolled past on Instagram. Companies with massive R&D budgets, deep pockets and decades of experience paying thousands of crores for something they could have built in-house. By the end of this video, you'll know exactly why this is happening, which of these bets are actually working and which ones are quietly failing. So hit that subscribe button now. Let's get started. HUL paid rupees 2,670 crore for Minimalist, a skincare brand that was 5 years old and had never run a TV ad. ITC paid over rupees 175 crore for a protein bar company behind the yoga bar brand. Godrej paid rupees 450 crore for a men's grooming brand, Moustache, you probably first saw on Instagram. Why would they do that? And more importantly, what does it tell you about where India's consumer spending is headed next? The lazy answer is DNA. Big companies cannot move fast, so they buy fast brands. That is partially true, but it is also incomplete. Because every single company in this story actually tried to build first. Every one of them failed. And the reason they failed tell you something important. Not just about FMCG, but about where India's consumer economy is going. Between FY21 and FY24, D2C brands surged with 40% growth compared to 9% for legacy FMCG. These premium brands charge 1.5 to 4.5x more than traditional alternatives. Driven by cheap data and informed consumers who research ingredients online, shoppers increasingly prefer modern, transparent brands over old-school legacy names, making traditional mass market advertising less effective. Now here is where it gets interesting for investors. The surface story looks like 4 companies doing the same thing. The underlying story is that each company was solving a completely different problem. Starting with HUL, the problem was relevance. Glow & Lovely was facing low single-digit volume declines. Talcum powder is a category in structural decline globally, and Pond's hold 55% of shrinking market. So HUL tried to build its own premium digital brand. They built Love, Beauty and Planet, backed by Unilever's global R&D, sustainability narrative and premium positioning. By FY26, it was at rupees 163 crore annual recurring revenue, that is ARR. Minimalist. The brand HUL eventually paid rupees 2,955 crore to acquire, was at rupees 850 crore ARR in the same period. That is a 5x gap between what HUL built and what HUL bought. And Oziva, another acquisition, went from rupees 104 crore in revenue and a rupees 43.5 crore net loss in FY24 to rupees 258 crore in revenue and a rupees 4.5 crore net loss in FY25. A 148% revenue jump and 90% loss reduction in 1 year. Marico's problem was not relevance, it was raw materials. In FY20, 73% of Marico's portfolio was commodity linked, primarily Parachute coconut oil and Saffola edible oils. When copra prices surged 113% year-on-year in FY25-26, there was nowhere to hide. Material costs jumped from 47.7% of revenues in Q1 FY25 to 57.4% by Q2 FY26. EBITDA margins, simply put, how much profit a company makes from its core operations before accounting for interest, tax and other adjustments that were 18 to 19% in stable years, compressed to 15.63% by Q4 FY26. CEO Saugata Gupta called the resulting price hikes unheard of. Parachute went up 60%. It still was not enough. Beardo's margins have nothing to do with copra prices. Plix's margins have nothing to do with copra prices. That is the entire logic of Marico's acquisition strategy, not just digital growth. Balance sheet risk reduction. Plix scaled 10.4 times from its FY22 base and turned profitable with 11% of EBITDA improvement. ITC's problem was different again. The cigarette business generates rupees 21,091 crore in annual operation profit at a 71.5% EBIT margin. The percentage of revenue left as profit after operating costs before interest and tax. The money is not the problem. The problem is that this money comes from tobacco and ESG-driven fund managers were exiting the stock. FPI holding fell from 15.6% to 12.96% in a single year. Meanwhile, ITC set a Rs 1 lakh crore non-cigarette FMCG revenue target for 2030 back in 2015. To hit that from Rs 21,982 crore in FY25 requires a 35.4% CAGR. The actual growth rate in Q4 FY25 was 3.7%. So D2C acquisitions serve two purposes at once. They demonstrate diversification to ESG-sensitive investors and they add fast-growing categories towards a target that is frankly unreachable by organic means alone. Emami's problem was the most straightforward. Between FY20 and FY26, Emami's revenue went from Rs 2,654 crore to Rs 3,779 crore, a 42% gain over 6 years. For a company with 67% volume share in cool oils and 54% of the balm market, that is slow. The reason? Every single Emami brand targets a mass, traditional, price-sensitive consumer. Navratna, BoroPlus, Zandu Balm, these are dominant brands. But the young urban male spending Rs 500 on a beard oil does not use any of them, and no product launch under Navratna or Zandu could ever reach him. The brand names themselves are the ceiling. Emami spotted this in 2017, earlier than everyone else, and made its first investment in the Man Company. Now for the honest part, because some of this is working and some is not. Marico's digital personal care portfolio crossed Rs 1,100 crore ARR by FY26. Beardo reached Rs 214 crore in FY25 revenue with profit after tax, that is PAT, up to 258% to 13 crore rupees. Oziva's turnaround under HUL is one of the cleaner acquisition success stories in recent Indian FMCG. But Yoga Bar is at Rs 202 crore in revenue with a Rs 69.5 crore net loss in FY25. Minimalist is growing at Rs 850 crore ARR, but margins are still recovering from integration costs. And the Man Company, Emami's flagship D2C bet, saw revenue fall 16% to Rs 154 crore in FY25, flipped from Rs 9 crore profit to Rs 22 crore loss, and tripled its advertising spend to Rs 43 crore. In the same year, Beardo, same category, also FMCG owned, grew to Rs 214 crore and turned profitable. That contrast is not about the market. It is about how you run the brand after you buy it. Industry data suggests many FMCG acquisitions fail to deliver expected synergies, largely because legacy companies cannot preserve D2C culture post-integration. The whole reason consumers choose these brands is because they did not feel like a big company made them. So if you are tracking this theme as an investor, 4 things matter. First, cost discipline. Does the acquired brand have controlled customer acquisition costs? Or is it buying growth through advertising the way the Man Company did in FY25? Second, margin profile. Brands with zero commodity link like Plix or Beardo are structurally more valuable to the parent. Third, integration approach. Marico explicitly gives founders control over 4 things only. Companies that push control too quickly tend to lose what they paid for. And fourth, the parent's actual problem. Buying to solve a real structural gap, as Marico did with commodities and Emami did with demographics, tends to produce better outcomes than buying to hit a target that math will not allow anyway. The acquisitions are real. The intent is sound. Whether the brand survives the integration is the question still being answered. And for investors, that answer will show up in the quarterly numbers before it shows up anywhere else. If this gives you a sharper lens to look at FMCG companies and their acquisitions, follow for more breakdowns like this and tell us in the comments. Which of these 4 HUL, ITC, Marico or Emami do you think is making the smartest bets right now? Subscribe to Invest with Share.Market for more such sectoral breakdowns.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.